Capital gain tax rates are about to potentially prohibit investment? Wow. Surprise announcement last week that capital gains rates could just about double for those in the highest tax bracket. I got those details coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up button. Last week on Thursday, sort of a surprise announcement came out of the White House that they're looking at increasing the capital gains tax rate to just about double for those that have income over $1 million. This is part of the next stimulus plan, not the infrastructure plan, but the American Families Plan, which is the stimulus plan after this one. Well, this one hasn't even been passed yet. They're still negotiating, and apparently coming up this week, the White House is going to unveil that plan, and they snuck out these capital gain increases. And I'll just tell you, the word on Wall Street is dislike. I'll tell you that. The stock market did not like it, dropped quickly 400 points. It's bounced back and around. We'll talk about that. But all right, let's level the playing field here. What's this big announcement? What's the context for historical tax rates? And what does this mean for you? Let's get into it. Okay, number one, for a long time, capital gains rates have been below ordinary income tax rates. In fact, well, I'll show you a chart later. It's basically for as long as we've got data. So capital gains rates are significantly lower, and here's how they work today. Basically, your long-term capital gains rates. So when you make an investment, when you throw money into your Fidelity account and you invest in something and it goes up in value, if you sell it within 12 months, then that gain shows up on your tax return as a short-term capital gain. It's taxed at ordinary income tax rates. So it's added to your income, and then it's taxed like your normal income, whether that's at the 12% tax bracket, 22% tax bracket, 24% tax bracket, 32%, whatever, okay? Those are short-term capital gains, something you bought and sold within 12 months. What we're talking about here is long-term capital gains. You bought something, it went up, down, went up, down, went up, down. Well, it went up, and then you sold it after holding it for 12 months, okay? Whether that's 13 months or 13 years, it's sold at capital gain, at a long-term capital gain. And right now, how that works is it lands on your tax return as a capital gain, but the capital gain tax rate that you pay depends on your ordinary income tax rate, okay? Look at this chart here. If you're in the 0% tax bracket, you're in the 10% tax bracket, you're in the 12% tax bracket, great news. There's an incentive to have capital gains. Your capital gains rate federally is 0%. That's incredible, right? So you can have capital gains in those low tax brackets and not pay any federal tax. Let me say that differently. The tax code is essentially saying if you're in a low ordinary income tax bracket, then you're encouraged to make capital investments and capital gains. You're encouraged because we're so encouraged that we're not even going to tax it. Phenomenal, okay? If you're in the 22% tax bracket on up, but your overall income's below, let's say $500,000, right around there, then you're going to pay 15% capital gains rates. And even though that's a lot higher than 0%, that starts at the 22% tax bracket, so 15% long-term capital gains is still better and more preferred than 22%, obviously better than 24%. If your income is above that $500,000 mark, then your capital gains rate jumps to about that 20% level. So that's how capital gains rates work right now. But there's a twist. Check out this chart. Back in the Obama era, they added the additional Medicare tax, the 3.8% additional Medicare tax. There could also be the net investment income tax. We're not including that one in here, but the additional 3.8 goes into effect when your income's over 200 or 250, depending on your filing status. Those capital gains are either at 0%, 15%, 18%, or 23% when you add in the additional Medicare tax, all right? So that's how it works today. All right, so what's changing? Well, nothing yet. They've got to pass it, but the White House has leaked out that when they introduce their next stimulus proposal, the American Families Plan, I believe is what they're going to call it, there's some indication that the White House is going to try to make good on a campaign promise from the Biden camp saying, you know, we want those that are wealthy, okay, so individuals with capital gain or with income above $1 million is what the White House is saying. We don't think that those individuals should pay a preferred rate on their capital gains. In fact, I'm not going to share the audio here, but there's some audio from President Joe Biden that says it doesn't make sense that those folks that have income over $1 million would pay a lower rate. They should pay tax at their ordinary income tax rates. And the White House has also said they want to move that ordinary income tax rate for the high wage earners, those earning more than $1 million, back up to 39%. If this is right, and if this all passes and goes through, capital gains rates for those making over $1 million, we'd go back to that chart, we'd add another layer. If your income is above $1 million, then your capital gains rate is actually 39.6%. Add on the 3.8 Medicare surcharge, the additional Medicare tax, and there you've got it, 43% for capital gains. I don't know how you look at this, okay? But to me, I'm a little concerned that this disincentivizes those who actually have had success and have high income. It discourages them from having capital gains. You could look at it the other way and say, no, they can afford to pay more tax, they should pay more tax. And I think that's how the White House is looking at it. But to me, I look and say, well, that's sort of a penalty on those who have had good investments. What's this mean to you? I first want to look at the historical perspective. This would actually put, because of the additional Medicare surcharge, this would actually put the capital gains rate for those earning $1 million or more, this would put the capital gains rate above their normal ordinary income tax rate. Again, looking at this chart, that blue line of capital gains rates, throughout our history, we've always had those capital gains rates at a lower percentage because we're trying to encourage people to make capital improvements and capital gains, right? We're trying to encourage that investment. And so I wonder if this would disincentivize it, okay? I mean, to me, I look at tax, I don't know how you do it, but because we don't just have a flat level tax for everyone, which I'd be a proponent of, by the way, because we don't have a flat level tax, I look at tax as a penalty. Basically, when there's high taxes over here, avoid that. When there's low taxes over here, move towards that, right? So, and you know, whether you trust politicians or not, I've yet to meet someone that contributes to their 401k and says, don't deduct it. Just I'm okay. I'll pay the tax on that. Right? Everyone is looking at the current tax laws and saying, well, I'm going to do certain things, and based on the current tax rules, and I'm willing to do things to get a tax improvement, tax deduction. Again, I look at it as a penalty, as a speeding ticket, as a speed bump. When there's high taxes over here, I try to avoid that. When there's low tax brackets over here, I try to move towards that. And I think we all do by our very nature, not because we're trying to scam the government or get away with something. These are the laws. They haven't set up a level playing field. It is, they're trying to manipulate behavior. Therefore, over here, when they increase tax, I want to go somewhere else, right? And so to me, I wonder if this does discourage individuals from making investments. I don't know. Here's a chart of historical changes to capital gain tax rates and what that's done with the market. Apparently there's no correlation to that. We'll see. We'll see if this thing actually passes and what the long-term impact is. Wall Street didn't like it initially, but then at the same time, we've got Wall Street on the euphoria of the continued money printing from both the Federal Reserve, but also the European Central Bank, Japan, all that sort of stuff. Everyone's printing money, and so it's hard for the market to really get spooked about capital gains rates when there's just, billions of dollars of liquidity being created at all times. So what does this mean to you? That's what I care about. Number one, recognize that many people can pay 0% federal capital gains. And with some creative tax planning of managing when you have that capital gain, when you sell that investment, you can structure your income, your capital gain tax, so that it's most of it's at the lowest rate, okay, 0%. And then maybe some of it at the 15%. So be aware of that. Do some proactive tax planning to take advantage of the 0% capital gains rate or the 15% capital gains rate. If you're someone that potentially could be subject to these higher capital gains rates, I wouldn't rush out and sell anything just yet. I mean, this is a long road before it would be passed. It's got to go through Congress and all that sort of stuff. But if it's passed, I personally expect it to take effect immediately. And so I wouldn't rush out and make some changes or sell some things, although lots of people sold crypto based on this because of all the capital gains that people have seen, investors have seen there. But I wouldn't rush out and sell anything just yet, simply because we don't know. This is just rumor. I wouldn't go out and make some permanent changes in the face of just some rumor. So that's the second thing. And then third thing, to me, this should not discourage you. It should not discourage you from investing. I dislike these tax changes, so therefore I would continue to use your tax shelters as much as possible for your investing. But listen, whether they're going to offer these same tax shelters or raise capital gains rates or whatever, you still have financial goals. You still have long-term financial goals that you're saving up for, and therefore take control of that. Continue to contribute. Continue to save up for those long-term financial goals of yours, and then work with your certified financial planner to pay the least amount of tax over your lifetime, managing proactively your tax situation and the tax laws to try to pay as little tax as possible. That's the goal of your certified financial planner. So work with your CFP on that. I'll give you more updates as we know more about the American Families Plan, the next stimulus bill, and more about these capital gains rates. So make sure you hit that subscribe button right here for those future updates. If we can help or you have questions, find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there too, or just give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.